This video complements Professor Tony O'Driscoll's competitive strategy course at Duke University, where he provides a brief overview of the BCG Growth-Share Matrix that resides within the classical quadrant of BCG's strategy palette. Let's begin. Hey everyone! Today, we're diving into a strategic tool you'll find invaluable in your careers, especially in tech and innovation-driven industries, the Growth-Share Matrix, also known as the BCG Matrix. Whether you're launching the next big app or managing engineering projects, this framework helps companies figure out where to invest their resources and why. It's all about balancing the short-term and long-term to stay competitive. Let's break it down into its core elements so you can use this tool to make data-driven strategic decisions. The Growth-Share Matrix is a 2x2 grid that evaluates a company's products, business units, or technologies based on two key factors. Market growth. How fast is the market for this product or service expanding? Market share. How much control or dominance does the company have over that market? Each of the four quadrants represents a different strategic situation. Let's look at each one. First up, stars. These are products or services in high-growth markets where your company has a high market share. Think of it like being a tech startup in a booming sector like AI or electric vehicles. You're a leader, and there's still massive growth potential. But here's the catch. You've got to keep investing to maintain that dominance. It's like driving a Tesla in the early days. Huge potential, but it needs constant investment to fuel its rapid growth. Example. Think about the iPhone when it launched. Apple dominated the smartphone market as it grew exponentially. Your goal with a star? Keep investing to stay on top. Next, we have cash cows. This is where things get a bit easier. These are products in low-growth markets but with high market share. They're mature, stable, and don't require a ton of investment. Basically, these are your breadwinners. They bring in consistent cash flow without much effort. Example, think of Microsoft Windows. It's a mature product in a low-growth market, but it continues to generate billions for Microsoft year after year. In engineering terms, it's like optimizing a process that works. Low innovation, but great returns. These products allow companies to reinvest in riskier, high-growth opportunities. Now let's move to the question marks. This is where things get tricky. You're in a high-growth market, but your market share is low. These are typically new products or services that could go either way. Do you double down and try to make it a star, or cut your losses? Example, think of Tesla's Cybertruck in its early stages. It was entering a high-growth electric truck market, but with competition from legacy brands like Ford. Could Tesla turn it into a dominant force? For these products, companies have to make tough decisions. Do they invest more or pull the plug? Finally, we've got dogs, products in low-growth markets and with low market share. These products or services aren't doing much for you, and they probably aren't worth much future investment. They might be kept around for strategic reasons, but typically, you're looking to phase them out. Example, think of IBM's typewriters in the 1990s. Once dominant, they became irrelevant with the rise of personal computers and were phased out. In competitive strategy, it's crucial to recognize when to let go. Holding onto a dog for too long can drain resources that could be better spent elsewhere. So, how do companies use this matrix? It's all about resource allocation. Stars and cash cows are your biggest priorities, while question marks are high risk, high reward. Dogs? Well, sometimes it's better to divest. The Growth-Share Matrix helps companies allocate resources efficiently and decide where to focus their efforts, whether to grow, sustain, or phase out a business unit. But like all frameworks, the BCG Matrix isn't perfect. It assumes market share is the biggest factor in success, which isn't always the case in today's fast-evolving markets. For example, tech companies like Amazon or Google often operate in ecosystems where interconnected services matter more than individual product dominance. Let's look at a few recent examples of strategy shifts using the BCG Matrix framework. Microsoft transitioned from selling software like Windows, a cash cow, to investing heavily in cloud services like Azure, now a star in its industry. Netflix made the tough decision to transition from DVD rentals, a fading cash cow, to streaming, which initially was a question mark, but evolved into a star and now dominates global content distribution. And Apple, with its focus on wearable tech, moved the Apple Watch from a question mark to a star, creating an entirely new product category in personal health. In each case, these companies use the matrix to guide their investment decisions, helping them to allocate resources and adjust to market shifts. But here's the thing, the matrix evolves. Today's stars can become tomorrow's cash cows, and a question mark can quickly turn into a dog if you don't execute properly. Netflix, for example, constantly invests in new content to stay a star, while old DVD rental services have long been phased out. Strategically, companies need to reassess their portfolio regularly, especially in tech, where innovation drives growth. As engineering managers, you'll be expected to make these kinds of calls, whether to push a new product to become a star or to let go of underperforming projects. So, let's wrap this up with 3 key takeaways. Stars need investment to maintain leadership in high-growth markets. Cash cows fund your future. Use them to generate consistent cash for new ventures. Be careful with question marks and dogs. Sometimes it's best to cut your losses and focus on higher potential opportunities. The Growth-Share Matrix is one of the simplest but most effective tools to help companies navigate growth, innovation, and competition. It's especially useful in fast-evolving industries like technology, where today's stars can easily become tomorrow's dogs. As future engineering managers, understanding how to prioritize resources, spot growth opportunities, and make tough strategic decisions will be crucial to your success. And remember, strategy is about making hard choices. The Growth-Share Matrix helps you do just that. That's all for today. Keep this tool in your back pocket as you navigate your way through competitive strategy, and use it to identify where your next engineering innovation might fit into the market. Now that you understand the basics of the BCG Growth-Share Matrix, consider how it might be best applied to the live case assignments in the competitive strategy course. Good luck!